Okay.
Hey, how are you doing today, Fed?
Great. I'm doing great. How are you, Kristen?
Awesome, I'm doing good.
Good.
We're excited to come with you today. My name is Kristen Perry with Remax Professionals.
And I'm Federico Montoya with Synergy One Lending.
And we wanted to take a little bit of time to come talk with all of you today about move-up buyers. Right now we're in the market where a lot of people are looking to get out of their current home and move into a larger home, or even move down to a smaller home if they're empty nesters.
Yeah.
And it's a good time to talk about that.
It is, absolutely, yeah. We have a few points to talk about today.
Yes.
So I don't know if you want to go over those or...
Yes, so we'll have 4 different ways that we can do that, and we'll go through each of them and then take some time with all of you guys. If you have questions, you can reach out and we can talk more individually.
Yeah, absolutely. We're always here ready to talk to you about this, so yeah, this will be fun.
Sounds
All
good. Okay. So the first option we can go with is to keep your current home as an investment property.
Yep.
And this is great because it allows you to invest long-term in real estate, and that pays off over time that you've had the home. So you have the opportunity for someone else to pay off your mortgage by living in the home while you gain that wealth, and you can either sell at a later time or continue to keep that property with you. This is also a great opportunity to consider in the short term if you're in a buyer's market and you want to take advantage of that buyer's market. Or if you were going to break even at closing or owe money at closing on the sale of your current home. This will also allow you the opportunity to make a non-contingent offer on another property. So then you have a stronger offer when you purchase your new property. If this is something that interests you, the first step would be to make sure that you think about what makes a viable rental property. With regard to that, the biggest thing we want to look at is making sure that you consider the amount you can rent your property for. I recommend checking sites like Zillow Rents to see how quickly properties in that area are renting and for what amount they're renting for. We want to make sure that this amount will cover your current mortgage, taxes, HOA, and costs of owning the property. And then you need to determine if you want to manage that property yourself or if you want to have a rental company do that for you.
Yeah.
The biggest difference between one or the other is that managing it yourself is a little bit more work, but you'll save some money. But hiring a rental company takes all of that load off of you, although there's the added cost to it. The pros and cons of those involve building wealth through real estate, waiting to sell until it's more of a seller's market and you can get more money for your home, and having someone else pay down your mortgage. The cons are that there is the added responsibility of a second home to manage, a second mortgage, and issues that arrive with home maintenance on both homes are things you have to consider. I'll let Fed take over and talk about what that looks like from the loan and lending standpoint.
Sure, yeah. So thanks, Kristen. Thanks. Those are great points. Definitely opportunity in this market, particularly if you have a low interest rate on your current mortgage. To hold on to that mortgage and turn that property into hopefully a cash flowing investment property. So what we look at from a lending standpoint and qualifying for the new mortgage is on all loans, we look at a monthly debt to income ratio. And that monthly debt to income ratio takes into account your current mortgage payment and what the new mortgage payment will look like. And of course any other monthly credit debt that you have. So it's a monthly debt to income ratio. It doesn't necessarily look at balances, just what your monthly debt payments are. So first, the thing to consider is my income enough to qualify for my current mortgage, my current monthly credit debt, and then the new mortgage payment? If it is, we don't really have to look much further. If you have a down payment saved, then that's basically what we're looking at is, okay, you can qualify without having to do much else. Even if you plan on renting out the property, you don't really have to document much. The next thing to consider is, okay, maybe my income isn't sufficient for that, and maybe I need to use the rental income to help me qualify by offsetting the current mortgage payment that I have. And what we look at there is we look at 75% of what you're going to rent the house for. So let's say, for example, you're going to rent it for $2,800. 75% of that is $2,100, and we use $2,100 to help offset your current mortgage payment to help you qualify. So, for example, if your mortgage payment is $2,400 instead of hitting you with that full $2,400 mortgage payment against your debt to income ratio, in this scenario we'd be hitting you with $300 in debt. So a huge difference there to help you qualify. $2,100 in rental income that we could use, and then versus the $2,400 mortgage payment, $300 in debt. That's what we look at. Now, in order to do that, documentation wise, you have to get a long-term lease, 6 to 12 months, signed by our renter, and then we also look to make sure that you have a security deposit from them, deposit in your bank account, equal to the first months of rent. So in this case, $2,800, and that you've also deposited the actual first month's rent into your account. And then that lease just has to take effect by the time your first mortgage payment is due on the new mortgage on the new house that you're purchasing. Now, we talked about down payment. If you don't have the down payment saved up, you might be able to tap into the equity in your current house. There's different ways to do that. Initially, the first thing to think about is a home equity line of credit, also known as a HELOC. And that is the most flexible way to access the money. It allows you, it acts like a line of credit. You don't pay on it until you access the funds. It's a great idea to, even if you're thinking about this, to start putting a HELOC in place now. And we could definitely help you with that. The thing to consider is some lenders, some banks on these HELOCs will ask you what the purpose of the money is for. Definitely a good idea to discuss that. It could be potentially for home improvement, or it could just be to have additional funds available. You don't know what you're going to necessarily do with the money at this time. You're just looking to put the HELOC in place. The other option would be, okay, we're pretty serious about buying a house. We want to get a second mortgage. That's a less flexible option. The interest rate is fixed as opposed to a HELOC where the interest rate is typically variable. So that's a plus on it. But getting a second mortgage, you're going to access all that money right away, which means you're going to start paying interest on the whole amount you're borrowing. So let's say HELOCs, second mortgages, let's say you're going up to $250,000, $500,000 high amounts. Mm-hmm. You're going to start paying interest on those high amounts right away. Whereas a HELOC, it gives you the flexibility of not paying until you access the money down the road when you're ready to buy. And then the third option is the cash out refinance, meaning you're just going to take your current mortgage and refinance it and tap into the equity in your current home. There are some caveats to that. You might need to call it an investment property if you want to buy a new primary residence soon afterwards within the next 12 months. Or maybe it is your primary residence and then you're going to hold off, but you're going to start paying interest on that mortgage right away, on that money that you paid out plus the mortgage. So plus the original principal balance that you currently have on your current mortgage. So there's some caveats there. It's not the best option, definitely not the most flexible option. And if you have a low interest rate, you probably don't, on your current mortgage, you probably don't want to do it. But we'll look at those options for you and decide what works best. And we'll talk about tapping into your equity even more later in another section. But,
That's awesome.
Yeah.
Sounds like there's a lot of good opportunities to take advantage. And I think the biggest takeaway is if you think you might be wanting to move in the near future, whether you're going to keep your property as an investment property or you're going to sell it, opening a HELOC is a great chance to have that money available if we need to make improvements before listing it, or if you need to make improvements before renting it, or if you want your down payment.
Right, yeah, absolutely. Putting that HELOC in place even as you're thinking about it, even if you don't do anything with it, it's not going to cost you much. I mean, HELOCs are like a $300 fee, maybe a $500 appraisal at the most. Okay. It's a really affordable option just to have that money in place and have that flexibility.
Awesome. Yeah. So the second option for move-up buyers is to sell your home simultaneously with buying your new home. This is the most popular option that most people do. Yeah. And so that process would involve getting your home ready to go on the market now, while also talking with your lender, Fed, to make sure that we can get you into the move-up home that you're looking at. So the first thing we would do, besides getting pre-qualified, which Fed will talk about shortly,
Sure.
is we would determine what the value of your home is going to be so that we can get a good estimate of what you're going to walk away with and your down payment. We would list your home either as soon as you're ready to go on the market or as soon as you go under contract with a property. The biggest thing with that is both of those are contingent offers. So what that looks like is that we offer on your home contingent to your current home selling. If your current home does not sell, then you have the opportunity to walk away from your new property. There's different ways that we could do this, but typically it would look like a 30-day close from the time that your current property went under contract and your new property went under contract, whichever date is later. Typically you close on the same day or within a day or two of both properties. The stronger contingent offer obviously would be to have your home on the market already so that the new seller or the new seller of your new home could see that you guys are serious and your home is ready to go. But if you're nervous about selling your home before you find a new property, we would want to have your home in show-ready condition so that within 24 hours to 2 days after going under contract, we could have your home on the market so that the sellers would see that you are working towards getting your home sold. There are pros and cons to this option as well. The first pro is that there's no risk to you as a buyer. So if your current home doesn't sell, you don't have to buy the new home. You're not risking having multiple mortgage payments. You're not risking your sale home falling out of contract and still having to buy your new home. You're able to terminate and get your earnest money back. The biggest cons of this are that the timing can be very tedious. There's a lot of additional dates and deadlines to meet. If your current home goes under contract before you find a new home, you may feel the pressure to settle on your next home because you're in a rush. Or if you find your dream home before your current property goes under contract, you may feel pressure to settle on sale price or other conditions of selling your current home. So there are definitely things to keep in mind. This is the most popular way to do it. And from the new home purchase side, I'll let Fed take that over.
Sure, yeah. In this situation, we do make sure up front, first of all, what you're going to be pre-approved for before you even put your house on the market, right? Because you want to make sure, yes, I can buy a new house in the price range that I want to be at. So we're going to definitely do a good job up front of making sure, before you take that leap of listing your house, that we've done our job of making sure that you can qualify. From a qualification standpoint, we're not worried about your current mortgage or any mortgages tied to your current house, because the plan would be that mortgage is going to be paid off through the sale of your house. And then the other thing we take into consideration is most likely how much are you going to get out of this current house based on your equity, right? So how much are you going to have available for down payment? Even though you might have $200,000 available, maybe you don't want to use all of that. Maybe you want to use 50. We look at those numbers and we dial on those numbers for you, so you can say, okay, yeah, I plan on putting this much down on the new house. Then when you go under contract with the sale of the house, what we look at is we revisit, right? Do you have any concessions? What is the timing of closing? What are your closing costs going to be? What are you going to walk away with as far as equity in this house? Kristen and I will work together on an estimated net sheet, making sure how much you should have available from the sale of your current house once you go through negotiations, so that we know how much you're going to have available for purchase of the new house, for down payment and closing costs. So we work hand in hand in that. We help you navigate this. Like Kristen said, with the timing, it can be, a lot of deadlines, a lot of making sure that everything stays in track together. But we do a good job of it. We've done a lot of it over the years, and to try to make it as seamless as possible for you. But from a qualification standpoint, you're just qualifying for the new mortgage and your current monthly debt payments, not the current mortgage, because that's going to be taken out of the way. But we definitely do a lot of it up front and go over a lot of numbers with you based on this. So,
And we're both very good about making sure that I'm doing a good job of estimating what you're going to walk away with on your property and being very conservative in that number.
Yes.
And Fed is going to do a good job of making sure that when we pre-qualify you, we're taking a conservative number into account.
Yes, yeah, we want to be conservative. Obviously, if you have more money, great. You could decide to put more money down, or just hold on to that money for your new house and whatever you want to do with that for your new home. So, yeah. Great.
So the third option
Yep.
for buying and selling and moving into your move-up home is to buy your new home before you sell your old home.
Right.
So this would require a lot of additional financial items, and Fed will address all of those as soon as I'm done explaining what this would look like from the real estate side. So there are a few ways you can do this, but it's a great opportunity for you to start looking for your new home now without the pressure of your old home selling before you do find your new home. What this first option would look like is that you'd find your new home, get all the way through the inspection process, make sure everything is moving smoothly to closing on your new home, and then we would put your old home on the market to sell. This would be a non-contingent offer, so it means that if your current home doesn't sell right away, you may have 2 mortgage payments. It also means that you might be in the thick of moving out of your property while somebody's trying to schedule showings or inspections. The option that would make that just a slight bit easier would be to wait until you've closed on your new home and fully moved into that home, and then we would list your current home on the market. It's a great opportunity because you don't have to deal with getting out of your house, making sure your house is constantly in show-ready condition. But there are some nuances that are involved in that as well.
Yeah.
Typically, homes that are staged or occupied sell for more value than homes that are not staged or occupied. So there is a little bit of an additional investment from a staging standpoint. So that would be a discussion that your real estate agent, myself, and you would have as to what the right option is to getting your home sold quickly and at the most high value that we can get for your home. No matter what your thought is on whether you want to get fully into your home or not, it's a good idea for us to start talking right away, and also for you to start considering what you want to pack up, donate, sell, things like that as you're going through all of your items. This is also another great opportunity if you have a lot of stuff in your home, or you don't have little children, you have a lot going on in your life, you don't want to be out of your home for showings, and you don't want to need to have your home ready to be shown at a minute's notice. This is also a good opportunity for somebody like that.
Yeah.
And
Absolutely.
I'll let Fed talk about the nuances of what that looks like.
Yeah, sure. So from a financing standpoint, once again, we're always looking at debt to income ratio, right? So if you could afford your current mortgage, any potential HELOC payment, if there is going to be one, to access the equity to put as down payment, and the new mortgage, we don't really have to look much farther than that. Now the question is, do you have that down payment? That's number one. Where is that down payment going to come from? Have you saved up the money? Now, in most cases, we could accept as little as 5% down. In most cases, sometimes 3%, but we'll say 5%. This blanket from you for down payment on the new property. Now, some people will say, well, I want to have the opportunity to access this equity and use the equity from my current house before it sells. I'm buying a new house. So the number one way to do that, once again, is the HELOC. And that's why we tell you, even if you're thinking about this, get this HELOC in place. The HELOC, in order to use a HELOC, you need to have the HELOC already ready and available, closed, before you list the home on the market. They won't give you a HELOC if you want to list the house or if you've already listed it. So once again, we want to start having these conversations sooner rather than later. Obviously, we're going to be here to answer your questions as soon as you start thinking about, we might want a new house. Right. We want to get that HELOC in place. The second option would be, let's say you don't have the HELOC in place. The second option would be what's called a bridge loan. What a bridge loan helps you do is it helps you access that equity, and if the house is already listed or is going to be listed pretty quickly, we could, if you need to move more quickly, the bridge loan would be the option rather than trying to put a HELOC in place. Pros and cons: HELOCs are cheaper. They're from a standpoint of the term of the loan, the HELOC, it doesn't put like a quick turn time for you to sell the house. Whereas bridge loans are typically like 6 to 11 months. You don't have to sell that quickly with a HELOC. The downfall to a HELOC is you might not be able to access as much equity. Most HELOCs kind of cap you at $500,000. If you have a lot of equity in the house, a bridge loan can allow you to go up to $750,000, even $1 million, pretty easily, actually. So, assuming you could qualify. So, from that standpoint, those are the two different options for a. Well, let me backtrack. Actually, on a bridge loan, the interest rates are higher than on a HELOC, and the fees are higher. So those are the cons to a bridge loan. Like I said, the HELOC has a typically lower interest rate, lower fees, but not able to access as much equity. A little more flexibility, once again, with a HELOC than the bridge loan. Now, the other thing to consider is, how do I qualify for this new home purchase? If your income is not sufficient to cover your current mortgage, the bridge loan payment, or HELOC payment, and any other debt that you have, the new mortgage, all that debt that we have to take into consideration, if your income is not sufficient for that, there are ways to exclude the current mortgage payment and potential HELOC or bridge payment. There's a lot of different programs in lending world that are out there. Some of them, they write a non-contingent offer on your house. If you have a non-contingent offer on your exit home, then we don't have to include any payments associated with that home, mortgage payments, HELOC payment, bridge loan payment. We don't have to consider any of those when looking to qualify you. That's one option. Another option is, okay, there's not just the non-contingent offer, but we're also going to offer you a bridge with that. There's that option, and that bridge might not even have a monthly payment for you. It might there's going to be fees that you pay out of that equity, but it might not have a payment for 6 months, something like that. But there's definitely things to consider with those options. We're going to try to find the one that is most cost effective, because they are more expensive. Mm-hmm. They're going to charge you fees for this service of putting a non-contingent offer on your house, but they're going to help you. Or we have other loan programs on the purchase of a new house that, as long as your house is listed, it might not take into account the mortgage payment on the current house. That's kind of a non-traditional type mortgage. Those typically carry higher interest rates, but it might be an option for you to get into the house, and then cheaper than maybe these other non-contingent offer options. But you might want to refinance down the road, which would cost you some money potentially to refinance. But we'll look at all these, lay them all out for you. We'll have some videos on these actually later on with a little bit more detail. But we're through this process, we're going to help you figure out which one is the best option for you. So
I have a question for you on that.
Yeah.
After you sell, if you've purchased before you sell, and you make more, if we make more money on the house than we were planning, what can we do with that lump sum?
Sure, absolutely.
Towards that loan if you only put 5% down? Right.
If you only put 5% down, and let's say now you have more money to put down, and let's say it's going to equal more than 20% of the original purchase price of the house. Well, first of all, you could take that money and you could look to buy down the mortgage, to pay down the principal on the mortgage, and do what's called a recast. So you only put 5% down, you're most likely going to have private mortgage insurance, you're going to put down a larger chunk of money. Now you could look to get rid of that private mortgage insurance. And then the other option is to recast. So let's say typically you have to be into the house for 2 to 6 payments before you can recast, depending on the product. But let's say you have this chunk of money now that you have from the sale of your house, you're going to take that money and you're going to pay it toward the principal, and you're going to request a recast. It's not a refinance. it doesn't carry as many fees. Your interest rate doesn't change, but you're going to take that, reduce the principal, and let's say you're 6 payments into the new mortgage. Well, instead of having the payment recast over 30 years, it's going to be recast over 29 and a half years.
Okay.
And so what it does is, okay, you've paid down, let's say, $100,000 on your mortgage. You want to reduce your mortgage payment that you have, get rid of the mortgage insurance. You're going to recast the new lower principal amount over those 29 and a half years, reducing your mortgage payment, your monthly mortgage payment.
Awesome.
Yep. Or if you want, you could keep paying the higher mortgage payment and pay your mortgage off sooner.
It's
That
true.
would be another option. But the recast gives you the flexibility. It's going to bill you based on a lower payment amount. The other option is, let's say you do have that chunk of money, but let's say 6 payments down the road, you're thinking about doing the recast, but no, interest rates have gone down, and it makes sense to refinance. Well, you could just refinance at that time, take advantage of a lower payment.
Mm-hmm.
And we might be able to get you a lower term, like a 29-year term, instead of a 30-year term. Let's say you don't want to lose that year. There's some flexibility there. We could do kind of what are called in-between terms for people too on refinances. So there's some flexibility there too if interest rates drop, in the next 8 months or so. We'll see. Yeah.
Awesome.
Hopefully.
Sounds like there's a lot of good ways to do it.
Yeah, we have a lot of options. The biggest thing is just talking through your scenario and figuring out what's going to work best for you. And of course, down the road, hopefully you get a lot of money out of your house when you sell it and
It's the goal.
can pay it down. So yeah, that's a great option to bring up too, Kristen. Thank you. Yeah.
Awesome. Thank you.
Yeah, absolutely.
Okay.
All right.
Well, our last option is to sell your home before you buy your new home.
Yep.
So this is the last common option that we see people do when they're moving up.
Mhm.
And that would be to list your home first, get it sold, get all moved out of your home, and then once we're under contract or once you're out of the home, then we start looking for your new home. So the pros of this are that we can write a really strong offer, and if you're trying to maximize your price point on your next home, this is a great option because you already know exactly what you're going to make off the sale of your home.
Yep.
You also can make a really strong offer because you're not contingent. There's also minimal to no risk of paying multiple mortgages at one time. The cons of this are that you could end up with a period of time where you're homeless and you're out of your home. The way we would try to solve this issue is to do a post-closing occupancy, which is where you rent your property that you're selling back from your buyers. We could look at doing a longer escrow, which does have some financial implications from a loan standpoint for the buyers, and locking in their rate. Or you could spend time in an Airbnb with family or other creative options like that to give you a place to go in between exiting your current home and moving into your new home. But overall, this is a great way to maximize the amount of money you're getting out of your current home if you're looking to really stretch what your budget is for your new home.
Yeah, absolutely. Yeah, those are all great options, and the post occupancy is what we see a lot of.
Mm-hmm.
I know there's times where it can't work, but that's obviously the first one you want to look at, right? I think, yeah. From a lending standpoint, there's not much difference than almost a simultaneous close, right? Where the main difference is we know how much money you're going to have. We don't need to estimate it now. We know how much money you're going to have to put as a down payment on the new house. And by then you've made your decision. We're still going to look to make sure we get you pre-approved based on how much money we think you're going to have, because you most likely don't want to sell your house without knowing what you could buy once it's sold, right? So from the simultaneous close that we talked about earlier, that's a very similar approach that we have from the lending standpoint. Obviously, most of the difference is going to be on the real estate side. From the lending standpoint, you no longer have your mortgage to worry about on the house you just sold. You're only worried about the new mortgage and any other debt that you might have. Maybe it's a situation by doing this maybe you have some credit issues and need to pay down some debt to help bring your score up to help you get a better interest rate. That would be an option with this, where you can't do that with a simultaneous close. Whereas if maybe there's a few months in between the sale of your current house and the purchase of the new home, you could pay down some debt, bring your credit score up, maybe get a better interest rate because you have a higher credit score. So that would be one other benefit from a lending standpoint for you. So.
And one caveat I would add to that,
Mm-hmm.
just in my experience working with you,
Mm-hmm.
is that before you just take that money and pay down something,
Mm-hmm.
make sure you're checking in with your lender, because
Sure.
there are different things you want to look at as you're paying that down.
Yeah,
Correct?
absolutely. Yeah, we would look at that from one before you even have the money, before you've sold the house. When we're doing the pre-approval for the new purchase, you're going to want to get the pre-approval first before you decide to list the house. Obviously, you want to make sure you're solid. So through that process, we do a credit pool, and we can run a simulator to say, okay, if you have this much money, what's the best way to utilize that to bring up your score? And now, what's the maximum score potential over the next couple of months? What does that look like? And then we run those numbers. Okay, here, based on current interest rates and a potentially higher score than what you have now, here's what your rate would potentially look like. So yeah, absolutely. We don't just tell you to go pay down debt here or there. There's a process to it. There's a plan. It's based on a credit simulator, and which is not 100% accurate, but is in the high 90th percentile accurate to work, assuming you don't run up other debt. But yeah, that's something that we help people with credit all the time. Credit issues and maximizing credit is we focus a lot on that. We want you to get the best rate possible, and credit usually is a big driver of that. So,
Makes sense.
yeah.
Well, overall, we've discussed today the 4 different ways that you can move out of your current home and move into your new home.
Right.
You can either sell before you buy before you sell, keep your current property as a rental property, or simultaneously buy and sell with a contingent offer. And I think overall, the biggest takeaway is that if you're considering making a move like this in the next 6 to 12 months, definitely give me and Fed a call so we can help you go through all of your options and make sure that have a plan set up so that you're ready to go when the time comes.
Yep, absolutely. We want to try to provide you as many options as possible, so the earlier you contact us as you're thinking about this, the more flexibility you're going to have. We can help you even if you decide, I want to list my house tomorrow. We can still help you figure it out. Obviously, the sooner the better. It's going to give you more flexibility, but we have options for all scenarios too. So we'll get it figured out for you.
We do.
Yeah.
Thank you, guys.
Thank you.